Alright, we have focused mainly on chart patterns such as head and shoulders, triangles and rectangles so far. These patterns rely heavily on visual interpretation of price charts. However, technical analysts usually do not rely on chart patterns alone. Instead, they often use additional tools called technical indicators. A technical indicator is any numerical measure derived from price data, market sentiment, or the flow of funds, money flows, that can help predict potential price movements. In other words, technical indicators take market information and transform it into mathematical calculations that may reveal patterns that are difficult to see directly in raw price charts. And many of these indicators are based on the basic idea of supply and demand in financial markets. For instance, if buying pressure increases relative to selling pressure, prices may rise. One of the simplest and oldest technical indicator is the moving average. The moving average has been used by statisticians since the early 1900s as a method for smoothing data. The purpose of smoothing is to reduce short-term fluctuations and make the underlying trend easier to observe. Because financial prices are often very volatile from day to day, a moving average helps analysts focus on the broader trend rather than the short-term noise. Now look more closely at the moving average, often called a MA. This is the short abbreviation of moving average, and it's simply the average of a stock's closing price over a certain number of periods. For instance, if we calculate a 20-day moving average, we take the closing price of the last 20 trading days. So this will be the average closing price for the last 20 days. So if we just add the closing prices of 20 days together and divide by 20 to derive the average closing 20-day prices, which is the 20-day moving average. Each day, the calculation moves forward by one period. So the newest price is added and the oldest price is removed. That is why it is called a moving average. So if we take the average of 20 days, and if the new day comes, we delete the oldest day and we recalculate the new 20-day moving average. So this is the moving average concept. And the key purpose of the moving average is to smooth out short-term price fluctuation. And stock prices often move up and down daily due to random news, market sentiment, or short-term speculation. And these short-term movements can make it difficult to identify the true trend. So by averaging prices over multiple periods, a moving average provides a more clear picture of the overall direction, the trend of the market. The most commonly used type is the simple moving average, where each price in the calculation receives equal weight. And the number of periods used in the moving average depends on the analyst objective, whether they want to study a short-term or long-term trends. So if you want to look at the short-term trend, you may look at the 20-day moving average, and you may also look at 60 or 180-day moving average to infer the long-term trends. So different moving averages are used to analyze different time horizon in the market. One commonly used moving average is the 20-day moving average. Because the typical month contains roughly 20 days, trading days, the 20-day moving average is often used to represent a short-term market trend. And another commonly used moving average is the 60-day moving average. And since a quarter of a year contains approximately 3 months of trading, the 60-day moving average is often used to represent a mid-term or longer-term trends. By comparing different moving average, a technical analyst can observe how short-term price movement interact with long-term market trends. So moving average can also be used to identify support and resistance level. For instance, during an upward trend, the moving average may act as a support level where price tends to stop falling and begin rising again. So if you move a moving average, it can be used as a support level. And similarly, during a downward trend, the moving average may sometimes act as a resistance level, preventing prices from rising further. Because moving average smooth price data, they are generally less volatile than the actual price series. This is the smoothing effect, because you take the average this property allows technical analysts to use moving averages in several ways. First, analysts often look at whether the price is above or below the moving average. So they check whether the price is below or above the moving average. If the price is consistently above the moving average, it may indicate that the market is an upward trend. So if it's above the moving average, you can suggest that the price is in an upward trend. On the other hand, if the price is below the moving average, it may indicate a downward trend. And second, analysts often examine the distance between the price and the moving average. Sometimes the price moves very far away from the moving average. Let's say this is the moving average, and if the daily real stock price may go far, deviate from the moving average. When this happens, the price may eventually move back toward the average. This is called a mean reversion. The price tends to converge to its average. So if it deviates far from the average, you may derive your investment decision. If the price breaks upward the moving average, you can expect the price will fall back and converge to its moving averages. So it's a kind of indicator to sell the stock. And if the price breaks down the moving average, you may expect the price to revert back to its average. So it may indicate it's a good timing to buy the stock. And when price rises sharply and then begins to move downward toward the moving average also acts as a support level. Conversely, when the price declines and then begins to move upward toward the moving average, here, the moving average may act as a resistance level. Let's reinforce the interpretation of moving average. As mentioned earlier, the relative position between the price and the moving average can provide information about the current trend. I think we explained this already. And this shows an example of a moving average applied to the Kospi index. This is quite old data, but this shows the moving average of the Kospi index. There is a 5-day, 20-day, and 60-day, 120 days, and 200 days moving averages. So you can see the moving average are smoothed rather than comparing the real price data. So the red line is the daily price movement, and these lines are smooth moving averages. In the chart, you can see the actual price movement of the index as well as the moving average line, as I explained. Notice how the moving average line appears much smoother than the daily price movement. So this smoothing effect makes it easier to identify the general trend of the market. And you may observe that price sometimes move above the moving average and sometimes below the moving average. And this movement can signal potential changes in market momentum. For instance, when the price rises above the moving average here, it may indicate the beginning of an upward trend. And when the price falls below the moving average, it may signal a weakening trend or potential decline. So indicative of a downward trend. Because selling pressure is strong, that it breaks down the long-term trend, which is measured by the moving average. And the charts like this help technical analysts visually interpret how moving average interact with price movements. And conversely, if the daily price deviate from the moving average so far, say here, you may expect the price will likely to fall back to converge to its moving average. And likewise, if the price break through the moving average and deviate the moving average too much, you may expect there was an overreaction, so you may expect the price to revert back to its average. Another important concept is moving average analysis is the moving average crossover, a bullish crossover or the bearish crossover. A crossover occurs when a short-term moving average cross above a longer-term moving average, such as 60-day or 120-day moving average This is called a bullish crossover. So when the short-term moving average cross above a longer-term moving average, it signals a good timing to buy the stock. So this is the bullish crossover. So, this means that the short-term prices are rising faster than long-term prices, which may indicate strengthening upward momentum. There is a strong momentum. Conversely, if the short-term moving average cross below, so MA from above, this means cross below. So when short-term moving average cross a long-term moving average from above, it means cross below. This is called a bearish crossover, and this may suggest that short-term prices are weakening relative to long-term trends. And one of the most widely followed crossover signals in financial market is the 50-day and 200-day moving average crossovers. When the 50-day moving average rises above the 200-day moving average, it is